We've talked about bonds before. As a reminder, bonds are a way for companies or really any entity to raise large amounts of money from multiple lenders. A company might choose to explore bond financing if they need to obtain more capital than they can obtain from any one individual lender. It's not the only option available in those situations, but it can be a viable option. I'd like to take a minute here, actually a few, quite frankly, and talk about how we determine the price of bonds and then how we're going to amortize those bonds over their lives. Now, bonds are either going to be issued at a premium, at a discount, or at face value, sometimes called par. And we have to understand what's happening with a bond. With a bond, what's happening is this. See, we have a face value here of $100,000 in this case. And we're going to use the same example as we go through this entire discussion. So at maturity, the company or entity that borrowed the funds is going to need to pay $100,000 to the bondholders. That's pretty small dollars for a bond issuance, but it keeps our math easy for this example. Okay, so let's keep looking at this. These are 4-year bonds. So what that means is that the company borrows the money, and then 4 years later, the company is going to repay $100,000 to the bondholders in aggregate. Remember, there are many, many bondholders. So it's not one person getting this $100,000. It's many investors in total getting this $100,000. Now, what also happens is, remember, when you borrow somebody's money, you're renting it and you have to pay interest. So these bonds are going to pay interest periodically. And in this case, it's an annual basis. So basically what's going to happen with this, let's take the face value of the bonds, which is $100,000, and the stated rate, which is 6%. That means that the annual interest payments are $6,000. Over the course of the next 4 years, the company that borrowed the money is going to pay $24,000 to the bondholders. Now you start to get a little bit of a sense regarding the bondholders' incentive to invest in bonds and the costs to the company for obtaining this method of financing. So if you look here, if you're an investor, in other words, you are the lender, what you're going to do is you're going to fork over some cash today, and then 4 years from now, you're going to get some cash back with the face value. But during that time, throughout those 4 years, each of the next 4 years, you're going to get an interest payment of $6,000, or you're going to get an interest payment. The total interest payments to all the bondholders will be $6,000 each particular year. So what we have to ask ourselves is, how can we figure out what the issuance price of this bond will be? It pays 6%. The face value in total is $100,000. But right now, the market rate is 4%. In other words, if I were an investor and I wanted to put money into an investment with a similar risk, I would earn only 4%. If you have not watched my videos regarding time value of money, you should pause this video and go back and watch those 2 videos. I have one that talks about using the present and future value tables, and there's another that explores using Microsoft Excel for time value of money calculations. And those concepts are so critical to what we're about to do right now. So if you haven't watched them, pause this video, go watch them, and then come back for all the fun that we're about to have. Because you see, when we're trying to determine the issuance price of a bond, we really need to know what the present value of 2 particular cash flows is. So we have this thing, and I'm going to abbreviate it, present value of a single sum. And what we're getting at with this is, here's the single sum. 4 years in the future, this company is going to need to pay $100,000 to its bondholders. The single sum of money is this $100,000. Now, we're going to use these time value of money tables. And admittedly, the only time I ever use these tables is in an academic environment. Okay, there are plenty of software tools available for doing present value and future value, time value of money calculations in general. Microsoft Excel is very powerful. There's a program called T-Value. I have an app on my phone, and I'm sure you could find a number of other resources. But in this discussion, it helps. It's kind of like learning long division before you are allowed to use a calculator. That's why we're doing it this way right now. So 4 years from now, it's $100,000. But $100,000 in the future is not the same value as $100,000 today, right? So what we have to do is we have to take this future value. The $100,000 is an amount in the future. What we wonder about is, what is the present value? What is today's value of that amount? Well, we got to take a look at this market rate. The market rate of interest right now, okay, in the open market for similar risk investment is 4%. So I'm going to this table called the present value of $1. That's your single sum right here. $1 is your single sum. It's one cash flow, not a series of cash flows. And if we take a look at 4% and then go over here to 4 annual periods, we find the intersection right here is 0.85 and some change. And I do believe that significant digits can matter. I actually don't believe that. I know that's the case. So bring it out to all the significant digits you have right here. And what we have is the rounded present value of this single sum is $85,480. What that means is this, okay? $100,000 4 years from now is equivalent to $85,000 and some change today. They're equal amounts as far as opportunity cost and investment return are considered. So if I told you, hey, you could earn 4% on an investment, and I give you the option, would you like $85,480 today, or would you like $100,000 4 years from now? A rational investor should say, those are equivalent, okay? I could take either one, and I would be ambivalent about those two. I'd be neutral. Now, the reality is there's certainly a risk factor, and there are other maybe qualitative, non-financial factors that would play into the discussion. But what I want you to understand is that $100,000 in the future is worth $85,480 today if the market rate is 4% and if these bonds have a term of 4 years. Now we also have present value of an annuity. I'm going to call it an ordinary annuity. That simply means that the payment happens at the end of a period instead of the beginning of a period. And what we're doing here is an annuity is, think about it, the word annual is kind of in the base of that word annuity. So if we have an annual payment of an equal amount, that's an annuity. Now the payment does not have to be annual. It could be monthly, it could be daily, it could be quarterly. In this case, we specified annual because I'm trying to keep things simple for you. But an annuity at its most basic definition is a series of periodic payments of equal amounts. Well, if you rewind the video, you'll recall that every year we're going to pay interest of $6,000. That's interest expense for the company. It's interest income. It's an investment return for the bond holders. And what we're seeing here is that that is really an annuity. So we go down to this table, present value of an annuity right here. Okay. So multiple cash flows, and we're looking for 4 periods, 4%. We get right down here, and we have our factor. Multiply that periodic payment amount by the factor in the table. And we see that if I round the amount, the present value of the annuity is $21,000, almost $22,000. So what that is basically saying is that a series of payments, $6,000 a year for 4 years, is worth $21,780 as a lump sum in today's dollars currently. Notice that just like the present value of this amount was less than $100,000, the present value of the annuity is less than the total of the payments. The total of the payments will be $24,000. $6,000 a year times 4 years. So the present value will, for all intents and purposes, for what you're doing, will always be lower than the future value. That's one way to check your work as you're performing problems and doing exercises and whatnot. So what's the bond price going to be here? Well, it's going to be the present value of the single sum. So the present value of the face value, I'm grabbing that from right here, in addition to the present value of the interest payments, the present value of the annuity. This bond will be issued at a premium, 107,260. Sometimes people might say that the bond was issued at 107, for example. What does it mean to have a premium? Think about this. 4 years from now, the company is going to repay $100,000 to the bondholders. But today, the company is receiving a little more than $107,000. The bond was issued at a premium because the company received more than the face value. And think about it from an investor's perspective. That means that the investors are willing to invest $107,000 today, but they're only going to receive $100,000 4 years in the future. Why would a rational investor do that? Well, here's the deal. These bonds pay 6%. They are more attractive than the market because any other investment at this point in time under these market conditions, an investment with a similar risk only pays 4%. So this is like buying a vehicle and the vehicle has an aftermarket stereo and maybe some nice wheels or a sunroof has been added. It's better than the alternative, so you're willing to pay a little bit more. And that's exactly what we see with these bonds. These bonds that pay 6% interest are better than the market, which only pays 4% interest. So bondholders are willing to invest more dollars. You see, the discount or premium in this case, is really the equalizer that allows or forces the company to borrow not at the stated rate, but forces them to borrow at the market rate. One final concept regarding this issuance of a bond at a premium. We need to record the issuance. So let's look at the journal entry. Okay. Remember, it was issued at a premium, which means the company is receiving more than the face value. So right now, the company receives $107,260. I'm going to abbreviate bonds payable as BP, just for space here. Bonds payable, that's a long-term liability, is going to get credited with $100,000. The journal entry obviously does not balance, and that's because we have this premium on bonds payable of $72.60. So right now, the carrying value, the initial carrying value of this liability is $107,260 because we have ultimately this liability to the bondholders, but we also have this additional amount that we received, the premium. What you're going to see in a few minutes is we are going to amortize this premium over the course of the next 4 years. We're going to amortize this premium to become zero. It is going to be a reduction of interest expense. The journal entry is going to be debit premium over here, credit interest expense, and you will see the interest expense will be smaller than the $6,000 payments. Remember I told you that a premium will effectively allow, even though these bonds pay 6% cash, that's the cash payment, it will allow the company to effectively borrow at 4%, which is the market rate. So at the end, at the termination of these bonds, when these bonds mature, this will become zero right here, and we'll be left with only the $100,000 face value. Let's look at an issuance price when it's going to be face value. And there's already a little clue that it'll be face value because the market rate is 6% and the stated rate is 6%. So in other words, these bonds are just as attractive as any other alternative in the marketplace. So what we're going to do with this is we have our present value of a single sum. And I'm going to go a little more quickly than we've gone in the past with some of this because now you're probably starting to get the hang of it. Take your market rate. Now, one of the errors you can make with these problems is you could accidentally select the stated rate. In this case, it'd be okay because they're equal. But your market rate is 6%, and then the number of periods here is 4 periods. What you're going to find is your present value factor for a single dollar amount, 0.792. And again, significant digits do matter. So the present value here is 79,000. You'll notice that it's a lower present value than what we saw a few minutes ago. As the interest rate increases, present value decreases, and vice versa. As the interest rate goes down, the present value will be bigger. And then we want to go over here for the annuity factor. Okay, present value of an ordinary annuity, and that's going to be the $6,000 periodic payment multiplied by the factor that we just identified over there. And as we do this math, we take solace in the reality that there is software that will do this for us. But we realize that we are kind of like learning long division. And we're figuring out that, okay, the present value of the face value is 79,209. The present value of the interest payments is 20,791. And remember when I told you that you could already tell, or at least I could tell, that this was going to be issued at face value, or sometimes people call it par value, because the market rate was equal to the stated rate? That's exactly what we see right here. Add the present value of the face value and the present value of the interest payments, and you will get to the issuance price of that bond. Finally, the journal entry, probably the simplest journal entry that we will see in this recording. Simply, cash goes up by 100,000, bonds payable goes up by 100,000. There is no premium, there is no discount, nothing's going to be amortized. Every year when we make the $6,000 interest payments to the bondholders, we will treat that as interest expense. And at the end of 4 years, when these bonds mature, we're basically going to do the reverse of this entry right here. We will credit cash, which payments to the bondholders, and we will get rid of the liability. Now, let's take a look at a discount situation. You see, the reason that these bonds will be issued at a discount is they're not as attractive as the market. Our bonds pay 6%. The market for equivalent investments is 8%, okay? If we don't offer a discount, investors will swipe left, okay? These are not as attractive as the market. So let's go through. If we take a look at the calculations, you're probably getting pretty adept at these. In fact, I've already pre-circled right here the factors that we need to deal with. So $100,000 is our single sum. The factor over here is 0.735 and some change. And we can see that the present value keeps dropping because the interest rate is progressively increasing in our examples. Present value of an ordinary annuity, which is expected. As a reminder, the interest payments are $6,000 every year. The present value factor from an ordinary annuity is listed over here on the table. And the present value of the interest payments is just shy of $20,000 right here. So the bond price is going to be the present value of the face value plus the present value of the interest payments. And that's going to give us an issuance price of $93,376. Which is a discount. It is lower than the $100,000 we see right here. That's because this is like the car that has a few dents in it, okay? Or the car that needs new tires or maybe a new engine. You'll buy it if the price is right, and that is the concept here. Investors will buy this, I hesitate to say damaged, but some investors will purchase this, will invest in this bond that is less desirable than the market alternatives. But they're only going to do it if you offer them a discount. And what exactly is that discount? Well, we can calculate it because the face value is $100,000. But as you might recall, just a moment ago, we determined that the issuance price is going to be this lower amount. So the discount is simply the difference between those two. Okay? We had to offer investors a $6,600 discount to entice them to swipe right and invest in our bonds. What does this look like as far as a journal entry? Well, if we're offering a discount, if we're issuing these at a discount, we're going to receive cash that's less than the face value. Now the thing is, the bonds payable account, this long-term liability, is still $100,000. If you pause, go back and rewind the video, you'll notice that in each of the scenarios where we recorded the issuance of the bonds payable account was credited by $100,000 in the premium, in the face value, and now in the discount scenario. That's because at the maturity date, 4 years from now, all that's going to be left is this bonds payable liability. And then, assuming we have the cash, we're going to pay that to the investors and the bonds payable liability will go away. But in the discount situation, we're going to have this account called a discount, probably called discounts on bonds payable in most bookkeeping systems or something close to that. And what you'll see is that this is really a hidden addition to interest expense, because over the next 4 years, as we make payments of interest to the bond holders, we're going to systematically get rid of this discount. We're going to credit the discount account each year, and we're going to debit interest expense. Remember when I said that a premium allows a company to borrow at market rates? The discount is forcing this company to borrow at market rates. Because you see, our bonds pay 6%. The market pays 8%. By receiving this discount, okay, by receiving less cash than the face value, this $6,600 discount is just enough to force our company to effectively pay 8% interest on these bonds. Yes, the periodic cash payments are 6%, but over 4 years, this $6,600 we did not receive on the front end is just enough to bump this effective interest rate from 6% to 8%. So here's an overview of the possible scenarios. In each of these scenarios, our bonds pay 6% because that's the rate. That's the stated rate of these bonds. If you are a bondholder, you will receive interest payments calculated at a 6% rate. Now, if we issue these bonds when the market is 4%, they're going to be issued at a premium because our bonds are better than the market. They're better than the next best alternative. So people will be willing to pay a little extra to invest in these bonds. And still 6% stated rate on our bonds. Now, if the market rate is 8%, we're going to have to offer a discount because our bonds are not quite as good as other investments in the marketplace. So if we want people to sign up for our 6% interest payments in a time when they could get 8% elsewhere, we're going to have to offer them a discount. We're not going to receive as much money on the front end. Now, if the stars align and it just so happens that the market rate is equal to what our bonds pay, then the bonds will be issued at face value, sometimes called par value. So, rule of thumb, if the stated rate is more than the market rate, bonds will be issued at a premium. If stated rate is less than the market rate, the bonds are going to need to be issued at a discount. And if the stated rate is equal to the market rate, go buy a lottery ticket because that hardly ever happens, but also issue your bonds at face value. Recall how I promised that the premium on bonds payable is really a hidden reduction of interest expense. So the premium in our situation a few minutes ago, and this is just the 3 situations we've been talking about, the premium, the face value, and the discount. The total premium was $7,260. The simplest way to get rid of that premium or to amortize it is just to use the straight line method. So what we're going to see here is that each year we're going to make, because remember the term of these bonds is 4 years. So each year we're going to make cash interest payments, I assumed at the end of the year, to our bondholders. So we pay them cash, and you might initially think, well, that's the interest expense. But that's not the interest expense, not the accrual basis interest expense. Because slowly we're going to reduce the premium on bonds payable. Initially, if you go back and rewind the video and you see how we recorded the issuance of a bond at premium, we credited an account called premium on bonds payable. What we're going to do over this time period is we're going to reduce that account, but at a rate of $1,815 for each particular period. And what's going to happen is, as we do that, the carrying value here is going to decrease. And as I promised, the carrying value drops to $100,000. So what you're seeing is this. When we are making these interest payments, and I'm going to show you a journal entry in a few minutes, even though the cash payment is $6,000, the actual interest expense on the income statement is a lower amount. And the reason it's a lower amount is because we're getting rid of some of that premium. That extra $7,260 that we received over 4 years, it's going to let us borrow effectively at a lower interest rate. There is a more detailed method that we could use. It's called the effective interest method. Similar kind of concept where we're making interest payments of cash of $6,000 and we're getting rid of some of the premium, and the interest expense is this lower amount, but we're not going to do it on a linear basis. With the effective interest method, what we're basically doing is we're taking the current carrying value. So in this case, the initial carrying value of the bonds, and as a reminder, that's combining bonds payable with the premium account. So the initial carrying value is $107,260. We're going to multiply that carrying value times the market rate. And it's important to pick the market rate because the market rate was used to determine the bond's price when we did that a few minutes ago. And so now we're going to use that same market rate to determine our interest expense. So what we're seeing here is that, and I'm going to round to the nearest integer, but our interest expense, let me just emphasize this, for the first period is $4,290 right there. Okay, we just calculated that. Now, how much of the premium is going to go away? Well, the cash payment to the bondholders is $6,000. If the calculated interest expense for this particular year is $4,290, that means that this reduction of interest expense is coming from the premium account. And what you'll see here, that $1,700, that is the amount of the premium that is being amortized. Okay? That's how we would calculate the interest expense and the amortized premium for the first period. And then what we would do is, since the premium on bonds payable is getting smaller right here, we have a new carrying value. So when you get to the next year, in this case 2016, what we're going to do is we take the new carrying value, 105,550, multiply that times 4%, and we get an interest expense, in this case, $4,222. And notice that interest expense is declining, right? Here's the interest expense right here. It's going to decline because we're going to be determining interest expense by multiplying carrying value by the market rate. As the carrying value declines, because the premium is being reduced through amortization, as that carrying value declines, the interest expense for each particular period will also decline. Now, to round this out, we need to figure out how much of the premium is going away. Take the $6,000 payment minus the $4,222 accrual basis interest expense, and you will see that the amortization of the premium, $1,778 for this year. And what you would do is, for 2017 and 2018, you would do the exact same thing. For 2017, you would take this new carrying value right here times 4%. It would give you the interest expense for 2017, and then you would reduce the premium. The carrying value would go down, give you this new carrying value here, multiply that times 4% for the final year's interest expense, and then we would be at maturity ready to repay the investors. Now that we've explored how to amortize a bond premium using both the straight line method and the effective interest method, let me just show you what the journal entry would be for an example of an interest payment. Now, I'm choosing to use the effective interest method scenario. I certainly could have used the straight line scenario as well, but we're just going to grab this one. So 12/31/2015, end of the year, we make a payment to the bondholders. Well, let's construct that journal entry. I can tell you right off the bat, and if you've watched my other videos, you know that I often recommend starting with the easiest, whatever is most logical for you. And in this case, at least for me, I know that, hey, and really for a lot of businesses, if you're going to pay somebody $6,000, you know that that cash is leaving your company. So why not start out with the cash? You don't have to. It's where I'm choosing to. Now, this is, and as a reminder, this is 12/31/2015. Then we know that we're going to have interest expense on the income statement. Recall, in a premium situation, the interest expense is going to be lower than the cash expense. The interest expense is being calculated on the accrual method, and it's going to be lower than the cash payment. And the reason is this. Go back and look if you need to at the issuance of these bonds earlier in the video, and you will recall that the premium that we recorded was a credit added to the liability. Now what we're doing is we're going to get rid of it systematically. So this portion of the payment that relates to amortized premium is reducing the premium. And you can see that over here. After this entry, the premium will now be $5,550. The carrying value, which is bonds payable and the premium netted, drops down to $105,550 over there. And we have recorded our first interest payment. If you understand this structure, you can easily prepare the journal entries for each of the next 3 years, because it's still going to be debit interest expense, debit premium, and credit cash. The credit to cash will be $6,000 for each of the subsequent years. The premium and the interest expense will be different dollar amounts based upon what we see over here. But at the end of the day, if you understand this structure, you can record one of these payments. Let's look at how we record interest payments when there's a discount situation. You might recall that when we issued these bonds at a discount, we received $93,000 and some change, but we're going to have to pay $100,000 to the bondholders at maturity. And that translates to a discount of $6,624. You might also recall that I suggested this is really a hidden increase to the interest expense for the company, because this $6,600 that they did not receive at issuance of the bonds is going to effectively increase their borrowing rate from 6% to 8%. We could do it on the straight line method like we did with the premium situation, where basically, see this $1,656, systematically for each of the next 4 years, we're going to amortize the discount. And what's going to happen as we get rid of that discount on the balance sheet, we're going to add it to the cash payments each period, and the interest expense will be bigger each year, right? Because remember, with a discount situation, we are effectively paying interest at a greater rate than what our bonds pay, greater than the stated rate. In the premium situation, the interest expense was lower than the cash payment, the accrual basis interest expense. In the discount situation, the interest expense each period is actually greater than the cash interest payment. So the straight line method is one option. Let's also take a brief look at the effective interest method. The mechanics are identical to what we discussed with the premium situation, at least as far as calculating the interest expense, but the journal entry is going to be slightly different. If you understood the calculations with the effective interest method with the premium scenario a few minutes ago, you should have no difficulty with the discount scenario, because the methodology is identical. You start with your initial carrying value. Now in this case, the carrying value is lower than the face value because it's a discount. When we were doing the premium situation, the carrying value was higher than the face value. And then we multiply by the market rate. Now that is one area where you could get tripped up. If you go back, if you rewind and look at our premium discussion, we multiplied the carrying value times 4%, which was the market rate that caused these bonds to be issued at a premium. Now we're multiplying by 8%. That's the market rate that caused these bonds to be issued at a discount. Okay, the 8% interest rate was used to calculate the initial price of the bonds. The 8% rate was used to create this discount account that is on our trial balance right now. So we need to use the 8% rate to get rid of the discount and to turn it into extra interest expense. And that's exactly what we're about to do here, because you see our interest expense, just like with the premium situation, it's going to be carrying value, current carrying value by the market interest rate, and no surprise right here, that's our interest expense. Now, the amortization of the discount becomes very simple at this point. You can pretty much do the math in your head because you're making a cash payment of $6,000, okay? But your accrual basis interest expense is this greater amount. How much of the discount will be amortized? The difference between the two. That extra interest expense is coming from this $1,470. Now, when we amortize the discount, what that means is the discount is going to get smaller. This reduction, a discount is really a contra account. It reduces the liability. So as this discount gets smaller and smaller, look what happens to the carrying value of the bond. The carrying value goes up and up. So the next year, when we want to calculate interest expense for the next year, we basically look at the new carrying value, $94,846, multiply that times 8%, and we get the second year's interest expense, which is right here. Okay, so what's going to happen with the discount situation? The carrying value progressively increases over the life of the bond, which means that your interest expense is going to get greater. It's going to be greater each year over the life of the bond because we're multiplying the market rate by a larger carrying value. And it's worth mentioning that I illustrated 2 years. Of course, we would do the same kind of procedure for the final 2 years of the bond. And by the time we do that, the discount account will become zero. The carrying value will be $100,000, and we will have recognized interest expense over the life of the bond for all 4 years. We need to record these interest payments. Let's take a look at the structure for this first interest payment, 2015. Now, however you want to start this is fine. You have to do what works best for you. I know in the premium scenario, I started with cash. I'm going to start with the interest expense this time because I actually, I do know that there is a cost of borrowing the money, so let's record the expense. And we know that the cash is going to be credited by $6,000. In fact, cash is credited by $6,000 under any of the scenarios we've discussed thus far. The premium, the face value, the discount, in all of those scenarios, the bondholders are expecting $6,000 payments, and we're going to make those payments. The bondholders don't realize that behind the scenes, we're doing some accounting gymnastics with accrual accounting to adjust our interest expense to be greater or less than the actual cash payments. And frankly, they don't care as long as they get their cash payments. But we know behind the scenes, we do have this discount account. And right now, it's hanging out on our trial balance as a debit balance. It's causing the carrying value of the bonds to be lower than their face value. So we need to get rid of that debit balance. We also know that in this journal entry I have right here so far, debits do not equal credits. We have to get rid of some of that hidden interest expense. Remember, the discount account really is hidden interest expense that forces the company to borrow at market rates even when the stated rate is below market rate. And what you're seeing right here, you're seeing that discount, the interest expense, come out of hiding right there. And when we combine that amortized discount with the cash payment, we get the greater interest expense that is forcing us to borrow at a greater rate effectively. Now, if you understand the structure for this particular journal entry right here, you should have no difficulty recording the payments for any of these 3 years right here. The structure will be the same. The numbers will be a little bit different in this case, but if you can do one period, you can do any of the others, I promise. Let's bring things full circle by looking at the balance sheet impact of the 3 scenarios. This bluish line up at the top is our premium scenario. This gray line here is our discount, and this orange, yellowish kind of line is face value. And you see what's happening is, at issuance, sure, the premium situation, the liability is greater than face value. That's because there's a premium account increasing the liability. And at a discount situation, discount issuance, the liability is lower than the face value. That's because there's a discount account that is reducing the carrying value. But that discount account gets smaller and smaller. So it's a smaller and smaller reduction, and the carrying value goes up over time. And back to the premium situation, that premium account that adds to the liability is getting smaller and smaller. So there's a smaller and smaller addition to the liability. And the liability starts to go down when we net those two. And of course, face value just kind of stays the same here. What I'd like to point out is, at the end of the day, and when I mean at the end of the day, I mean at maturity, when these bonds mature, which in this case is a 4-year term, at maturity they will all end up at a carrying value equal to the face value. The face value scenario is the most straightforward because right here you basically issue it at $100,000 and at maturity it's $100,000. In the premium scenario, the issuance price is greater than face value. As we amortize the premium, it becomes a reduction of interest expense on the respective income statements. And then in the discount scenario, this discount gets amortized and it increases our interest expense on each of those respective subsequent income statements. And that carrying value impacts the recognition of interest expense. Remember, with the face value situation, the carrying value was constant, equal to the face value, $100,000. And so each year right here, the interest expense is a level $6,000 each time we make payments to the bondholders. Now, if we look at the premium situation, you might remember that the carrying value was decreasing. Now, not significantly here, but you can just tell interest expense was a little higher here than it was here. And then the next year, interest expense is a little bit lower, and it's a little bit lower yet. We're not talking about material numbers here, but you do see that the interest expense declines over time in the premium situation because the carrying value declines over time. And then finally, if we take a look at the discount situation, we know that the carrying value is climbing, right? We start with a lower carrying value, which means that the interest expense will be lower initially. It goes up a little bit, goes up a little bit, goes up just a little bit more in that fourth period. Now, that's only a 4-year bond. If the life were longer, the differences could be dramatic. Also, if the discounts or premium, if they were larger amounts, the differences could be dramatic as well. But that's the fun world of bonds, guys. It's not everything you need to know. It's a very challenging topic. I understand this. So rewatch this video a couple times, and I think you'll be masters at figuring out the issuance price of bonds and figuring out how to record those interest payments and turn those premiums and discounts into items that impact interest expense.